Okay, let us look on technical analysis as one of the stock picking strategy which can be used by investor to select stock to be included in a portfolio. Now under technical analysis, we shall define what is technical analysis, what is stock market cycle, what is Dow theory, and also shall look on stock key drivers of market movement, which are greed and fear, and also we shall see on how an investor or an analyst can trade on signal in identifying buying and selling shares or signals. Now, what is technical analysis? It says technical analysis, this is a methodology used to forecast the direction of price movement through study of past market data, which is price and the volume of trade. So according to technical analysis, they forecast the direction of market by looking the past data related with prices and the volume of trade. So through this, the technical analyst will be in a position to predict whether in the future prices will be rising or will be going down. So they look at the past history of market data, primarily price and the volume of trade. Now say the technical analysts believe that stock market have dynamics or force of their own, independent of those of economic forces. So technical analysts base trading decision on past price and the volume of data in order to determine the past trend and the pattern which will be used to predict the future behavior of the market. So technical analysts usually attempt to forecast short-term price movement, and then that movement will help to predict what will happen in the future. Now, this methodology rests on belief that stock market history tend to repeat itself. So they try to study the past history in order to use it to predict what will happen in the future. Now, according to technical analysts, they believe that if a certain pattern of price and volume has previously been followed by a particular price movement, it is suggested that a repetition of that pattern will be followed by similar movement in the future. Now we have a number of assumptions by technical analysts. So say assumption of technical analysis. These were suggested by year 1966 by Levy. Now, the first assumption is that market price of shares or securities such as shares and bond is determined by supply and demand. So they assume that the price will be determined by supply and demand. And number two, they say that demand and supply are determined by numerous rational and irrational factors, which include both objective and subjective factors. Number three, we say apart from minor fluctuation, the prices of individual shares or securities and the level of the market as a whole tend to move in trend which persists for a significant period of time. So there is a fluctuation, but that trend is up or down tend to persist for a certain period of time. And number four, they assume that trend change in reaction to shift in supply or demand. This shift in demand and supply can be detected by or detected in the market, in the action of market itself. So the trend change, whether it is a rising trend or falling trend, if there is a change, this result as a result from demand or supply. So say this shift in demand and supply, it can be detected by the market itself. Now after that, let us move and see what is stock market bubble and the stock market crash. Now, stock market bubble, we say this is the economic situation taking place in the stock market when market participants drive the stock price above their value in relation to some system of stock valuation or in relation to intrinsic value. So, the stock market bubble is a situation whereby a market participant drive or forces the price to go above the intrinsic value or the collective value of share. And the stock market crash, this is also defined as a sharp dip sharp dip or sharp decline in share price of shares in the stock market. Now say this is parallel with various economic factors which result into economic crashes. So the main reasons for stock market crashes is due to public loss of confidence on shares of a particular company, and also panic to larger percent of investors who will be selling the shares of that particular company or shares traded in that market. So if many are selling, so it means the price will be going down. It will go below the collective value or collective price of that share. So say stock market crashes and speculative economic bubble. So the stock market crash, this is the complete opposite of stock market bubble. So the stock market bubble is when market participants are buying, so the demand will be greater than supply of those shares. So price will go above the collective value. So if there is any information which will make investor be aware that the price is above, so when they will stop buying, the market or the market will change its direction and will start going down. Now, after we've looked on the stock market bubble and the crash, let us see what is trough and what is peak. Now, trough says this is the lowest turning point of a business cycle or market cycle. So trough, this is the lowest turning point of business cycle. And the peak, this is the highest point between the end of economic expansion and start of economic contraction. So peak, this is the maximum turning point, the highest turning point of the business cycle or economic cycle. So these will be, shall see them later on. Now after that, let us look on market cycles. Now market cycles, we say these are ups and downs in the market. So say this can be seen as a part of cycle that repeats itself at irregular interval over time. So market cycle, this is up and down movement in the market, and they normally tend to repeat at an irregular interval over time. Now we have the upward trend. This is called the bull phase. So the upward trend in the market, it is known as the bull trend or bull phase. And the downward trend, it is called the bear phase. Now later we shall define what is bull and what is bear phase. Now also there is a flat trend or sideward moving in the market. Now say technical analysts, those who employ the technical analysis, they have tools which help to identify the momentum within trend, and the other tools to identify periodic variation in value about mean in order to identify turning point in the trend. Now we have a graph which shows up and down movement. So technical analysts, they draw some lines in order to establish the trend. So normally the technical analyst, they want to know the changing of the trend in order to identify whether it is time for buying or selling. So if the prices are rising up, so they need to establish when, at what point the price will reach maximum and start going down. So technical analysts sell before the prices start going down. So you need to establish so at what point prices will be at the maximum and they start going down. So they sell before the prices start going down, so in order to avoid future losses. And also they want to identify the turning point, the lowest point, so that they can buy at that point. So if that is the lowest point, so they buy. So they predict after that time, after that point, prices will start going down. No, will start going up. So they buy at the lowest price or at the low price, and when the prices start going up, they will sell at a profit and the benefit. So we have a graph. You can see from this trend of prices. So there is an upward trend, and also there is a flat movement, and also there is a declining trend. So you can see the trough, and also can see the peak. So trough says the lowest turning point of the economic cycle or business cycle, and the peak, this is the highest point of the economic cycle. So say analysts try to predict the momentum of the trend and in order to identify the buying or selling signal. So analysts try to predict turning point in the trend to find the buy or selling signal. So they sell in order to avoid future losses, and they buy in order to make a profit in the future when the price start rising.